Hello and good afternoon, everybody. Thank you so much for joining us today. As accountants, especially this time of year, we feel extra appreciated when people voluntarily choose to spend their time with us. Today, we're going to talk about setting up your practice, and what it really is a high-level introduction to incorporation. And we hope to dig away at a lot of these topics in future sessions, but this will lay some groundwork. I know we have some familiar faces on with us today, but for anybody that's new and we haven't met before, my name is Jennifer Daw. I'm a partner at Henry Warren and I work in our tax group, and I'll hand it over to my partner, Michelle.
Yeah, thanks, Jenny. So my name is Michelle Bouchard, and I'm one of the accounting and insurance partners here at the firm. So I've been working with Jenny here for over 10 years. And over those 10 years, we've been lucky enough to have the privilege of assisting clients over a wide range of, or with a wide range of their financial challenges and opportunities, including helping them navigate their first foray into entrepreneurship. So on that note, we'll go through today's agenda and what to expect. So we'll kick off the presentation by discussing the merits of incorporation, including the right timing and some important considerations to keep in mind during that process. And then we'll discuss what your first steps should be post-incorporation, how to figure out how to pay yourself, and then we'll talk about some important tax and HST deadlines that you should keep in mind for your first year and on a go-forward basis. So throughout the presentation, we really want everyone to participate, and we'd encourage everyone to please add questions to the Zoom Q&A box. And so we'll talk about them at the end of the presentation, or if they fit throughout the presentation and we're able to address them, then we'll just chat about them as we go. So we are utilizing Menti today, and so this will allow us to be able to interact with everybody. And so for anybody not familiar with Menti, so you can scan the QR code showing here on the screen, or you can go to menti.com and enter that code that's showing just on the left there. And so if you miss it at this point, that top bar will be there throughout the whole presentation. So if you miss it now, no worries, you'll be able to access it throughout the presentation. So on that note, we'll go through our first poll of the presentation. So we just wanted to get a feel for the crowd. So our first question is, how confident are you when it comes to your accounting and taxes? Just give a few minutes for people to participate. Thank you. Okay, so it's looking like people are feeling, so-so, somewhere in the middle. Okay, perfect. So I guess that gives us a good feel that still a little bit of confidence to go. And so hopefully I'll be able to give you that today. So on that note, Jenny, do you want to go through the merits of incorporation?
Mm-hmm. So when we ask questions about how confident you are with income tax and accounting, what I'd start by saying is that no matter where you are in the life cycle of perhaps your business in this context, it can be an intimidating place to be. And that's something that we really work with our clients to make it less intimidating, and also to educate in a way that that knowledge can make you feel confident in the decisions you're making, and certainly on a compliance perspective, or in an ability to grasp those opportunities that are out there. Now, the focus of this presentation is on incorporation, and I want to start by talking about some of the non-tax reasons to incorporate. So the concept of having a separate legal entity, a potentially limited liability, and we can talk about that a little bit further when it comes to professional corporations, and the idea of having a more complex structure to facilitate different business needs. Now, more complex structure can be great from a business perspective, but what it also allows us is a lot of flexibility from a tax perspective. And again, we're not going to dig that deep into that corporate group today, but I want to mention that just in terms of structuring the affairs. Now, the real meat and potatoes of today are the income tax considerations. And when we look at it, we're really thinking about income and how we're being taxed in any given year on a corporate and personal level. And we would start by talking about the theory of integration. Integration means that for tax purposes, whether you earn $1 as an individual or you earn $1 through a corporation and ultimately flow those funds out to yourself personally, you should be no better or worse off from a tax perspective. The taxes should be the same. Now, because of different political landscapes, different provincial legislation, constantly changing laws regarding tax, this isn't always the case. Further to that, there's the concept of income tax deferral and income tax smoothing or income tax splitting, which are ultimately tax savings. So we'll get into how those work, because that's really where we as tax planners have the opportunity to work with the rest of your team of legal and financial advisors to take advantage of that as a business owner. So if anybody's joining us from outside of Ontario, I will make a note, these are Ontario rates, but the concepts are the same. As an individual in Canada, we are taxed at the graduated rates that individuals have, which means as you earn more dollars, that additional dollar can push you into a tax bracket on which your marginal tax is going to be higher. And when we think of it in terms of a January to December year, that doesn't give a lot of flexibility. Your income is your income, and you're taxed based on the amount you earned in that year, regardless of whether the previous year or the following year had a different amount of tax. When we talk about small businesses or the idea of incorporating, this is where entrepreneurs really have some potential to have what we call the income tax deferral or income tax savings that might not be afforded to employees or even sole proprietors with that flexibility. So again, Ontario rates, the first 500,000 of active income earned in Canada in a Canadian resident corporation in Ontario is 12.2%. Now, on my previous slide, you saw that the tax on an individual income could get up to as much as 53.53%. Compared to 12.2%, you might say, well, slam dunk, that tax is a lot less. And I'd say, well, even if it's on active business income over 500,000, your rate is 26.5%. And what I would remind you is, at the end of the day, once the funds flow out to you as the individual, it's going to be taxed at a personal level again. So by having the ability to save those funds inside of a corporation, there's a couple of benefits. One, politically, they would say, well, you have more capital to invest in your business, which can be true, especially in the start, or if you have a large expansion. If you pay 12.2% or 26.5%, those after-tax dollars can be used to invest in your business. What they can also be used is to invest in your future. So again, working with your advisors and looking at that plan, your corporation as an entrepreneur and an incorporated business is to potentially have savings within your corporation and use that deferral to plan for your future income. So throwing out a numerical example, this really looks at that personal graduated rate. If an individual earns $200,000 of salary, they are going to attract an average tax rate of around 34%. And this would leave the individual with $131,000 in that particular calendar year. In this example, rather than earning the funds directly, the funds are actually earned through a corporation. And what we can see in this case is the active business income is $200,000. The individual has identified, well, I need a salary of $100,000 to pay my personal cash flow, fund my personal goals, and the rest I'm actually able to leave behind inside of the corporation. You can see that the total tax paid is actually considerably less than in example one, and that's where we have the deferral. Income smoothing is where we get into the idea of savings. Now, in our first example, we've deferred tax until some point in the future. But remember, when those funds are taken out by the individual, they'll be taxed again at their personal graduated rates. So depending on the amount of income that an individual is recognizing in that year, they could actually benefit significantly from deferring or pushing that income into a lower personal tax bracket year. And you would say, well, this doesn't sound all that dissimilar from an RSP. You contribute and get a deduction while you're working, and you pull the money out in retirement when you have access to those graduated rates. And I would say, yes, it's a similar concept, not taking into consideration how the income is going to be taxed inside of that corporation. So with another numerical example here, we have an individual in year one that is earning $300,000, and in year two, they've earned $100,000. And they're being taxed at their graduated rates. The total tax payable over the 2 years is $144,000. In example two, the individual is recognizing that personal income over 2 years. So perhaps it was earned in the same way, $300,000 in the first year, $100,000 in the second year. But by recognizing it or taking it out of the corporation in a way that smooths their income, the aggregate tax is $137,000. So again, identifying the timing that the funds are actually required to come out of the corporation, what you need for your personal needs, can actually help in smoothing that income and having those graduated rates be lower on your ultimate income and the tax that's paid thereon. So I throw this question out to the group because it seems like there's lots of great reasons to go and incorporate. When is the right time to incorporate? All right. So if you've ever spoken to an accountant before, especially a tax accountant, they're almost always going to say it depends. And we really should have put that as an option because it's such a personal consideration as to whether or not incorporation is right for any individual. Now, there are benefits to each of these times in incorporating. The simplicity of incorporating right off the start is great. That growth is in the corporation. You can immediately start saving. There's not a whole lot of complexity in transferring a business that may be established as a sole proprietor and then transferring it in at a later date, which is possible, but has its complexities. When we talk to clients about incorporation from a tax perspective, what we're normally talking about is personal cash flow requirements and family income. How much do you need in any given year after tax to fund your lifestyle? If the answer in the short term is every dollar that you're earning, which may be true, especially earlier in the business life, well, maybe incorporation doesn't make sense immediately because we can't take advantage of that deferral if income tax is our primary motivation. The other thing we talk about is an investment plan for the future. What is your strategy? And this is where we would work with your advisor to make sure that the strategy that you're looking at is consistent with your overall plans. Current assets of the business is something that we would look at. Have you already started the business? What's the best way to transfer those assets to the business on a tax-deferred basis? And that's something that I work in significantly with my time. And then I'd be remiss, even though it's not the point of this particular webinar, is to talk about the potential of a future sale of the business. So whenever we talk about a business, whether it's a sole proprietor or corporation, the exit plan is so important. Is this a vehicle for saving for the future, or is this a business that you're going to grow and sell? And there can be a lot of advantages to incorporation. Again, a whole webinar on its own, but we had to mention it here. So if you get to the point where it's time to incorporate, I will say that you can Google it online and you can go onto Industry Canada, you can click a button and you can create a corporation. Best practice to make sure you have the best setup and the best structure going forward is to speak to your accountant, because what they're going to do is they're going to take your objectives and they're going to work backwards to help you structure that. Who are the shareholders? What different types of shares do you want? What are you trying to achieve? Income splitting, income deferral, and there we can consider that. The corporate lawyer is going to take those objectives in those directions and actually set up a structure that makes sense and works well for you. So again, I'd recommend building that team right from the beginning to make sure that things are set up appropriately for you. If you are a professional, what I would like to mention, especially in choosing how to incorporate and when to incorporate, if you are governed by a professional body, there can be certain restrictions on the corporation, what you're able to do inside of the corporation. There may be restrictions on who the shareholders of those corporations can be. But in general, the idea of incorporating as a professional, the benefits are still there, just like many of the other businesses we talked about, in terms of planning for your future and that income deferral and ultimately the goal of tax saving. So I wouldn't say that that it's something that should be a limiting factor. What I would say is there's additional considerations that you'd want to talk to, again, your accountant and your lawyer about when setting up that corporation.
Okay, so now that you've determined that a corporation is the right fit for you, you've gone through the steps of incorporation, we'll talk about what those, or we'll dive into what those critical first steps should be after you've incorporated your business. And so what, I guess asking the crowd, what does everyone think, or what would your guess be for what your first step should be after incorporating? Just give a few minutes, see if anyone has any ideas. Celebrate. I like that one. Call my accountant. Yeah. Shameless plug for myself. I would agree. Okay. These are all great ones. Thanks for submitting those answers. So our three first steps we wanted to highlight today. So the first one being opening a separate bank account. So Once you've incorporated, we always recommend getting that dedicated business bank account opened up right away. It's a crucial step for ensuring that there's some separation between your personal and your business finances, which not only simplifies your accounting, but also makes sure that you're protecting your personal assets. For the opening of the bank account, you will need your articles of incorporation, your share register. So you'll need to wait until after you've incorporated, but those documents you'll be able to get right away from your lawyer. So you can do that as soon as you're incorporated. The next important step would be getting a effective bookkeeping system in place. So getting that set up right away to make sure you're tracking your finances effectively right from the get-go. So there's really 3 tiers of bookkeeping systems you could look at. So you could keep it simple with an Excel template, and that could be really great for your first year of business, or if you know that, on a month-to-month basis, the volume of ins and outs on your bank statement are on the lower side, maybe an Excel spreadsheet would work great for you. And if that's an intimidating thought to create one yourself, definitely reach out to us. We have a lot of great templates that we would be willing to share with everybody. The second tier would be using an online bookkeeping platform. So I'm sure most of you will have heard of QuickBooks, Xero, Wave. We're a big fan of QuickBooks Online. It allows you to link all of your business accounts, and it's really seamless to use. And so that's our recommendation if you're going to go the route of a platform. And the third tier, is if you just want to outsource it completely, you don't want to have to worry about doing your own bookkeeping, you want to focus on your business, you could outsource to a bookkeeper. And so your accountant may have a bookkeeping team, but if not, they work with a lot of great bookkeepers. So don't hesitate to ask about that. The key for a bookkeeping system, anyone you use, is to do it often. So at least quarterly, just so you're feeling in control throughout the year and it's a little bit less stress at tax time. And on the topic of stress, HST. So the HST rules are really complex, and that could and likely will be a presentation topic just in itself. So if you haven't secured an accountant at this point, this is always where we'd recommend reaching out to your accountant and getting some advice. And there's really 4 considerations with HST. So 1, do you even need to register at all? So you'll have heard, or most of you may have heard, of the $30,000 threshold for registering for HST in an annual period. But not all revenue is HST taxable. So you should chat with your accountant about whether that even makes sense for your business and whether that's a consideration that you need to have. The second would be, if you are eligible, when you should register. So of course you could wait until you're over that $30,000 threshold and register then. But if you've incorporated your business or set up your practice and you know that there are some big capital expenses that you'll have, like maybe you're doing some leasehold improvements or you're buying some equipment, registering right from the get-go will make sure that you're able to claim the HST that you've spent on those expenses, and that you're able to get that the HST back, which is really beneficial for businesses. The third consideration is your filing frequency. So if your annual revenues are under 1.5 million, you have a lot of flexibility on whether you can file annual, quarterly, or monthly. And so what you choose will really depend on your business and usually your bookkeeping system, what makes sense for you reasonably to file. And then the fourth is the filing method. So most of you will have heard of the regular method of filing for HST, which is where you're remitting your HST collected on invoices. So if you're in Ontario, that's 13%, and then you get to reduce it by the HST that you've spent on expenses. However, there is another method called the quick method. And so this is available to registrants with gross sales of 400,000 or less. And it can be really beneficial for businesses that have a lot of revenues, but don't require a lot of expenses to earn those revenues. So without getting in too much into the details, this will allow you to reduce, you still collect the 13%, but you get to remit less HST to CRA. So it can be really beneficial for companies in that space. So definitely worth chatting with your accountant on whether that makes sense for you. And while you're chatting with your accountant, you may have the question, how do you pay yourself? So before we jump into that, so another poll we have is, which form of remuneration, being salaries versus dividends, do you think is more tax efficient? So one of the many perks of incorporating is you have a lot of flexibility on how you pay yourself, whether it be with salary or dividends. And so I'd be curious to see what people think. So it looks like most of you think dividends. And to steal Jenny's answer from before, the classic accounting answer, it depends. So with both salaries or dividends, they have their pros and cons. So salary, the con would be, of course, there's a lot more administration with it. You have to withhold tax withholdings like your tax and CPP, and then remit those to CRA throughout the year. But the big benefits are generating RSP room. It allows you to pay into CPP, and it generates earned income, which is crucial for being able to claim tax deductions such as childcare costs on your return. The other benefit is it's deductible from your corporate income, so you get a corporate tax deduction for this type of remuneration. Dividends on the flip side, so they are taxed at a more preferential rate on your personal return, but you don't get a corporate tax deduction for them. And unlike salaries, the big benefit of dividends is that it's just a really flexible way to pay yourself. So you don't need to stick to a fixed schedule or remit anything to CRA throughout the year. So that can be a big draw for a lot of people. So when we're looking at salaries versus dividends, it's usually not a one-size-fits-all situation. And what works best for you is usually very specific to your life and your needs, and likely a mix of both of these makes sense. I know I'm a fan of paying at least an element of base salary to make sure that you're paying into CPP and getting to utilize those registered accounts. But for some people who hate the administration of salary or have inconsistent cash flow in their business, and salary may not make sense. And so that just really highlights the importance of chatting about it with your account so that you can look at your company specifically. Where you don't have a lot of fun planning options or flexibility is with your deadlines. So for Canadian corporations, understanding your tax obligations is really important to avoid interest and penalties, especially now. The CRA rates on unpaid installments or late payments for your corporate tax or HST is now at 10%. So it's really increased in the amount of additional cost to a business. It's usually not worth it to not pay those tax amounts throughout the year. So we'll start by looking at the corporate tax, and then we'll go into HST. But for corporate tax, the filing deadline is 6 months after the end of the year. So if you have a December year end, you need to make sure that you're filing your corporate tax return by June 30th. However, if you do owe corporate taxes, that payment deadline is actually shortened, and it's 3 months. And I should say this is for most Ontario corporations. I know Quebec has a shorter payment deadline of 2 months, I believe, in most instances. So again, make sure you're chatting with your accountant about the deadlines in your specific province. But what we usually tell clients is if you have to calculate what your taxes owing are at 3 months, you might as well file it and get it all done at that point anyways, if it's feasible for you. And for installments, so your first year of being incorporated, you don't have to worry about installments, but after that first year, if you owed more than $3,000 in federal taxes, there is a requirement to pay installments in that next fiscal year. So it's based on what you owed in the previous year. And for corporate taxes, for the most part, it's due on a monthly basis. For corporations with perfect compliance, you can do quarterly, but we usually just advise monthly to be safe. And for HST, so a little different than corporate tax, but the payment and filing deadlines are on the same day. And so it's 3 months after the end of the year. And that is for annual filers. So if you're a quarterly or a monthly filer, your deadline to pay and file is the end of the month following when that quarter or month ends. And also if you're an annual filer, that's when you may be subject to installment requirement for the next year. Again, you're off the hook for the first year, but then once you file your first return, if you owed more than $3,000 in HST, CRA wants installments all throughout the next year on a quarterly basis, again, based on what you owed that year. So to use installments as a segue, I hoped you enjoyed our second installment of our webinar series, and we loved getting a chance to chat with you guys about the basics of incorporation and setting up your practices. And so at this point, we'd love to hear from you and answer any questions you have. So I see one question in the Q&A. Okay, so the first question, and can everyone see that if I have it on here? Can you see that, Jenny? Yeah, okay, great. So the first question is, what if you start as a sole proprietor May 2024? What happens for tax filing? So for this one, I'll answer, I guess, two parts. So if you start as a sole proprietor in May, then on your being a sole proprietor, you file that on your personal return on a business schedule. And so you, oh, Jenny, do you want to answer that? Oh, sorry.
No, go ahead.
Okay. So you would file on your individual, like personal tax return. But then the flip side of this, say the question was, you know, you were a sole proprietor up till May 2024, and then you incorporated, what would happen then? Well, for that, you'd file on your 2024 tax return. So it would still be due the same time, April 30th the next year. So you'd file your business schedule of, you know, Jan 1 to the end of April. And then starting in May, when your business corporation starts over, that's when you'd start recording all of your business activity in there. Jenny, do you want to? Okay.
Sure, I'll answer that one. So the question is, can you highlight the differences between personal professional corps and regular business corps from a tax perspective? So from a tax rate perspective, they're actually very similar. The corporate tax rates are really going to be dictated based on the type of income that you're earning, i.e. active business income or passive income, and under those regimes. So when you think about a professional corporation, they're often running active businesses or earning income through a partnership, or even if you think about a lawyer billing another law firm or a doctor billing a hospital, that's considered active business income. A regular business income, maybe it's generated based on a business that can grow or foster on its own without a profession. But maybe the main difference that we see in those is really where they're headed. So if a professional corp is something that can't be sold, then oftentimes it's used even more as a vehicle for the future planning rather than a regular business corporation, where we may want to be more attuned to purifying. But in terms of highlighting the differences from a tax perspective, just from a tax rate perspective, they're actually quite similar. If we look at how income comes out of those corporations, and I talked about some of the limitations in a professional corporation when we have shareholders, regular business corporations don't have the same limitations. So for example, perhaps you can add in a spouse or children as shareholders, and subject to TOSI or tax on split income rules, you may be able to stream income out to those individuals in the form of dividends. In a professional corporation, each governing body dictates who is allowed to be a shareholder. It may limit the ability to add voting shares to individuals who are not active in the profession. It may also limit the ability to use trusts, and trusts are something that we like to use to have a lot of flexibility. So that's the main difference in terms of setting up an organization at the very beginning when we think about addressing those tax concerns.
Thanks, Jenny. Okay, great. So does anybody have any other questions that we can help with? So either today, or if you want to shoot us an email, both of our contact information is shown here, and so we'd be happy to answer any questions. So.
All right. Well, thanks everyone for attending today. We really appreciate it, and feel free to reach out to us if you do have any questions.
Great. Take care. Bye, everybody.